We are covering the critical topic of standard mileage rates and transportation expenses. The exam will test your knowledge of three key rates which the IRS sets annually. For business use, the rate changes frequently to reflect economic conditions. There is also a specific rate for medical and for active duty military members moving purposes. Finally, there's a statutory rate for charitable driving fixed at 14 cents per mile, which rarely changes. The exam will always provide you with the specific rates for the tax year in question, so don't memorize the numbers, memorize the rules. One of the most heavily tested concepts is the difference between non-deductible commuting and deductible business transportation. Your daily drive from home to your main job site is always personal commuting and is never deductible. Imagine a consultant who lives in the suburbs and drives 20 miles to their primary office in the city. That 20-mile trip is non-deductible. If, from the office, they drive 10 miles to a client's location, those 10 miles are deductible business transportation. The trip from the client's location back home is also considered non-deductible commuting. The exam loves to trap test takers with a home office scenario. If that same consultant's home is their principal place of business, the trip from their home office to the very first client of the day is fully deductible. The home office transforms the entire trip into business travel. Next, you must master the choice between the standard mileage rate and the actual expense method. Let's say a taxpayer drove 10,000 business miles, using a standard rate of 67 cents per mile. The deduction is a straightforward $6,700. To use the actual method, they would need to sum up all vehicle-related costs like gas, oil changes, insurance, registration fees, repairs, and depreciation, and then multiply that total by the business use percentage of the vehicle. A common trick question involves parking fees and tolls. Remember that parking fees and tolls incurred for business purposes are deductible in addition to the standard mileage deduction. They are not part of the standard rate. The decision to use the standard versus actual method in the first year a vehicle is placed in service has permanent consequences. This is a major exam topic. If you choose the standard mileage rate in the first year, you retain the flexibility to switch to the actual expense method in a later year. However, if you choose the actual expense method and take any depreciation deduction other than straight line, such as MACRS in that first year, you are barred from ever using the standard mileage rate for that car. You are locked into the actual method for the vehicle's entire life. Remember this phrase for the exam: start standard, stay flexible. Start actual, you're stuck with actual. If you do switch from the standard method to the actual method, you must use straight-line depreciation for the car's remaining estimated life. Finally, substantiation is key. The IRS requires what's called contemporaneous records. This means the taxpayer must keep a log with the date, mileage, and business purpose of each trip, recorded at or near the time of the trip. The exam might present a scenario where a taxpayer has legitimate expenses but no log. In this case, the deduction is disallowed. Without a detailed log, there is no deduction, regardless of the method used.